Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better understand how we're currently positioned and what we see in the global landscape. Obviously, the economy continued to be slow. Ben Bernanke a few weeks ago announced quantitative easing 3. Let me explain exactly what that means. What he intends on doing is continue to buy treasury bonds, long-term dated treasury bonds that hopefully drive down rates or keep them low. But he's added buying mortgage-backed securities. By buying mortgage-backed securities, what he's trying to do is drive down interest rates on home ownership. This makes home ownership more affordable. So whether you have a mortgage now, rates come down, you can refinance at cheaper rates, meaning there's more money in your pocket to spend on other things, which creates obviously demand in the environment. You have more money to spend. More demand creates more jobs, and it's a trickle-down effect. If you don't own a home ownership becomes more affordable because, again, cheaper mortgage rates. So this is a big plus. I think ultimately what needs to be done, depending what happens with the election, either candidate needs to come up with some kind of program on underwater mortgages. People who are paying their mortgage, but unfortunately we're caught up in this whole problem where housing values came down, they're paying a 6% mortgage, they need to refinance at a cheaper rates. The banks won't talk to them because they don't have enough equity in the home. I think ultimately if our government came up with a program like that after the election, I think that would be another big positive for the economy because, again, think about all these 25% of homeowners that are underwater on their mortgages. If they can refinance just at current rates, they'd have more spendable cash flow in their pocket to spend in the economy, which will create, obviously, demand and more jobs. So these would be positives. I think oil dependency, away from obviously oil dependency and using the resources we have here at home, which we have a ton of oil in the U.S., offshore and natural gas and coal. In fact, we're one of the richest nations overall in all of those basic products. And if we can use what we have at home, again, creating more jobs at home. So what you really need to look at is our economy is muddling along. The PMI number, Purchasing Manager Index that came out this morning was under 50, came out at 49.7. That means contraction. It means a slowing economy. It means a slow economy. Last month was 53. Ben Bernanke, I believe, saw some of these weakening signs and basically reacted to those and doing this mortgage-backed security bond buying program and extending the program they have in low rates out to 2015. These types of maneuvers will ultimately help the economy. Will it create some inflation? Yes. I don't think we're going to see Jimmy Carter Day inflation. I'll tell you that right now. Currently, we are positioned in commodity-based ETFs, and I want to make a little comment about that. In my newsletter last week, I wrote that investors should never buy commodities. When I talked about commodities in my newsletter, I meant futures, trading physical futures. That way in the commodity side that's leveraged often 9 to 1 on leverage. So when I talked about commodities in my newsletter, I meant buying futures. Don't do that as an investor, speculation, unless you're some short-term trader and you like a lot of risk. Buying base commodities in a portfolio, I think, are a great opportunity. In fact, we own the DBC currently. Again, positions can change at any time, so I want to warrant investors on that. But we currently own the DBC, which is basically owns 14 broad-based commodities within that investment. And I believe as the economy muddles along, and if we do have a little bit more inflation, ultimately commodities are inflation-based and they should react positively towards that. We currently own large cap in the U.S., small cap, and mid cap in the U.S. We're primarily invested within the U.S., and we do have a percent of our overall portfolio over in Europe, coming through the bottoms of that, and also outside of the emerging market Asia, which is mostly Japan. Now, positions can change at any time, as I talked earlier, but ultimately, if the economy can muddle through this, meaning this bad news looks like it's kind of baked in the cake at this point, so bad news kind of becomes good news. So when it's all rosy and great and things are all off to new highs, that's when most people want to jump aboard and basically get more risky. What I like to see is the bad news actually doesn't react that negatively towards the investment markets and things start to go up on bad news. That means a lot of that's baked in the cake, and that means ultimately you come out of a recession or a mild slowdown and things ultimately get better. Remember, all a recession is a cooling off or resting period. These are natural progressions in any economy. We've had a lot of recessions in the last 1,500 years. We're going to have many more recessions in the next 50 or 100 years. As long as the economy grows, people become wealthier over time. natural progress. You take a step back, you take 3 steps forward. This is Brian Resnick. I hope this was of interest to you, and hopefully you learned a little bit from it. If you're a client, of course, and you have a question about your portfolio, please call the office. If you'd like to become a client, we always like taking on new clients who want to better their situation. Call our office for a consultation. Until Sunday's show, make sure you have a great Friday and a very safe weekend. We'll see you and talk to you on Sunday on this live show. It's going to be a great show, by the way. You're going to learn a lot of new things, and I'm going to talk more about this economy and what we're currently doing, and more importantly, what we're avoiding. Have a great weekend.